So if you had 3 rules for investors about what they should do, particularly new investors, what would they be?
I think right now education is the #1 thing. You have to know what you're doing before you do it. If you're a new investor and you don't understand what the word short means, that's like kind of going to work without your full toolkit. And you need to just spend a little bit of time just looking at some of these definitions and these ideas to get some really good education in what does all this mean. Once you have the tools, then you should go out there. Do that first, though. Know what you're doing first before you kind of put the real money in. The second thing is diversification, but real diversification, not just smattering it out there and hoping that that's a really good thing. And the other thing I think is hedging and making sure that the downside is protected. So have alternative investments that will work opposite of a normal portfolio and put sell stops, an out strategy. Out strategy is #1 right now with the way markets are going and I think where they are going too.
And with diversification, your idea of that's a little different than what people think of diversification.
Yeah, traditional diversification is just having a lot of things. You have to do real diversification and find those asset classes that don't work in tandem. And in my book, we write about this thing called the flower garden theory of diversification. Most people have a flower garden and they have 1 or 2 types of flowers. I live in Florida, so we have impatiens. They come up and they look beautiful. But in the winter, they look great. In the summer, they're just stalks and dirt and ugliness. You want to have impatiens and roses, heliconias, and you want to have evergreens like money markets and fixed income. You want to have really things that don't necessarily work together, non-correlated. And I think diversification these days should really also add different investing styles. So if I am thinking buy and hold, for example, well, maybe I could do some trading. Maybe I could do some kind of we talk about the edge strategy, but something that's not going to be exactly the same, because what we saw in 2008 and what's shaping up in 2009, it doesn't matter what your investment was essentially, except for cash. Cash did fine. Everything got hurt. Some a lot more than others, but everything still got hurt. Really, it wasn't anything that went up like we saw in normal circumstances.
So with hedging, you mean placing some short bets and some long bets that counteract each other?
So you take the opposite side of a particular transaction. So to make it very easy, so if you have a portfolio with all sorts of different things in it, well, maybe you can pick up an ETF that invests in opposite of the S&P 500. So you have at least one thing, like in the flower garden we talked about, you have at least one thing that will be going up when everything else is going down. And what I always say is when you see the hedges and your negatives going down and just getting killed, you're happy because the rest of your portfolio is doing well.